President Trump gets his big, beautiful bill, but markets are still wary of tariffs. Indian automakers slow down, and why Facebook parent Meta is already winning at AI. This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode 133 of the Stock Doctor podcast. I'd like to start the show off by wishing, belated Independence Day wishes to all my US listeners. I hope all of you had a wonderful 4th of July with your families and loved ones, enjoyed, and I hope the weather is as sunny, but not as humid as the one it's in London. So I hope you guys had a great time, and I hope you had much better weather than what we are having. It's really sunny, but trust me, it is absolutely humid and muggy today. Anyway, coming back to the markets, coming back to the show, it was a very holiday shortened week on account of the 4th of July holiday. So much so, Thursday, markets closed early, and Friday was the full day holiday. So it was essentially, we got 3 full trading sessions, 3.5 trading sessions in total, with 3 full trading sessions. But boy, was it still an action-packed one. In fact, if you ask me, I think we got literally like 2 weeks of data and analysis and all of that packed into 3 days. It was that much action-packed one, even though it was a holiday shortened trading week. We had the jobs report. We had a massive update on President Trump's big, beautiful bill. We even had some updates on tariffs and trade deals, and there was even little time left over for a Musk versus Trump 2.0 to take place as well. Once the dust had settled, all 3 indices ended strongly in the green once again, although they started the week yesterday in the red. The Dow finished up the week last week with up 2.3%, S&P 500 jumped 1.7%, and the tech-heavy NASDAQ was up 1.6%. To give you more evidence on why this has been a volatile period, this why simply a week of green and week of even when the markets jump throughout the week, it doesn't necessarily mean that there were no periods of volatility. So to give you more evidence on why this was a volatile period in the US, the VIX, the VIX, the volatility index, essentially jumped 7.1% for the week. A very unusual development given that markets ended in the green. It is very unusual for the volatility to jump that high when there's a lot of positive sentiment in the market. But hey, such has been the regime that volatility is the name of the game, as I've been trying to repeat, as I've told you multiple times over the course of the show. Now, lots to talk about. As such, I'm not going to waste any more time. Let me introduce you to Doctor's Weekly Snapshot and discuss the key developments, as always, that took place in the US markets in the week gone by. Now, as I've mentioned before, holiday shortened week it may have been, but there was absolutely no shortage of action. And there was absolutely no shortage of data for investors to digest. If I have to define the last 7 days of US markets, and that means, 7 days of trading, not trading, whatever it is, 7 full days of US markets, then I would split it into 3 themes: trade deals, big, beautiful bill, and US jobs. And I'm going to start off with the third one, the US jobs data, and then go down further into trade talks and the beautiful bill as well. So let's start with the jobs data. We had the June jobs report. We had the June jobs report that was published on Thursday. Remember, Friday was a holiday. And the US economy, and if you look at just on the face of this jobs data, right? If you just were to skim through the jobs data, just on the face of it, you would see that it's a good report, but there's a lot more to decipher. There's a lot more to analyze. Now, first, US economy added 147,000 jobs in June, exceeding street expectations. Fantastic. Unfortunately, the good news ended there. If you take a deep dive, as we do in this show, if you take a really, really close look at the jobs report, then you would find out that it's not exactly a rosy picture. Most specifically, there are significant weaknesses in private sector hiring, which has slowed to its lowest level since October 2024. Now, 147,000 jobs might have been added, but nearly half of these new jobs were in government, not the private sector. Private employers actually added only 74,000 jobs in June, a massive, sharp decline compared to previous months. More than half of private industries cut jobs, in fact. So 74,000 jobs were created by private, but more than half of the sectors actually cut jobs. A rare occurrence since, get this, April 2020, since the days of the little green guy who came and destroyed all of our lives with COVID pandemic. Since then, We have not seen this picture where more than half of the US private sector actually cut jobs. The slowdown is obviously this job slowdown, the cutting jobs, all of this can be attributed to the usual suspects, the suspects that have been bubbling underneath, which is high interest rates, stricter immigration policies, and obviously tariff uncertainty. There's a further twist to make matters worse. Healthcare, social assistance, leisure and hospitality, and construction were responsible for 94,000 of the 147,000 jobs. In fact, more than 50% of the new jobs added in June were attributed to healthcare, social assistance, leisure and hospitality, and construction. But get this, these four sectors only represent 36% of private non-farm employment, which gives further evidence as to how, the scene is not as rosy as it seems. Yeah, 147,000 jobs were added. 94,000 of the 147,000 were actually added by these four sectors, which only make up less, which actually make up less than 40% of the overall private non-farm employment. The remaining sectors, including professional services, manufacturing, and wholesale trade, collectively cut, not added, cut 20,000 jobs, which goes to show once again that the labor market might seriously be in a weakening phase right now. Manufacturing jobs actually declined for the second consecutive month, while high-wage sectors like semiconductors and machinery particularly affected. So semiconductors and machinery were those sectors within manufacturing that got affected, and it declined for the second straight month. This shouldn't be surprising given that many companies are actually holding off on hiring and investments due to unpredictable economic conditions. And these conditions have become all the more uncomfortable and all the more unpredictable just yesterday, when President Trump announced that there would be the reciprocal tariffs would be imposed on some nations starting August 1st. The letters have been sent. Countries like Japan, South Korea, Indonesia better gear up, or at least sort it out in the next 3 weeks. From August 1st, reciprocal tariffs are going into further effect. So conditions have gotten certainly a lot worse. Manufacturers are also hesitant to hire due to potential changes in trade policy, something I just highlighted, and some firms are even limiting hiring in anticipation that artificial intelligence, get this, first time I'm ever mentioning this on the show, and first time we've ever had to discuss the impact of AI on the labor market, but some firms, especially, I can even give you some examples. Some firms like Adobe are even limiting hiring in anticipation that AI will increase efficiency and reduce the need for new employees. From a candidate's perspective, both young people and older job seekers are finding it much harder to secure employment, and with more applicants per job and increased anxiety among candidates. Now, the significant weakness that is starting to emerge in the labor market should put the Fed in a bit of a conundrum when it comes to rate cuts. It should be absolutely no surprise that a lot of Fed officials recently have started talking about rate cuts, unlike previous times. While Chair Powell has insisted that the Fed would be data dependent, I simply don't see any particular reason for holding off on rate cuts anymore, especially with some major cracks starting to form in the US labor market. Economists predict that the weak labor market will persist through the second half of 2025 as uncertainty continues to hold back hiring plans. Once again, let me repeat, this uncertainty got a lot more worse yesterday when President Trump imposed tariffs, announced that tariffs will go into effect from August 1st on the likes of Indonesia, Japan, South Korea, and a couple more other nations. The concentration of job growth in a few sectors is seen as a warning sign for future overall employment trends. It's the same thing as, when stock markets go up and the entire market was driven by just Mag 7 and nothing else. Well, clearly, if you don't have equal distribution, if there's no broadening of the bullish sentiment in the markets, then clearly it doesn't take much for the whole thing to tumble. And we did see some weakness in the months of April when tariffs were introduced. Mag 7 fell off, the whole market fell off a cliff for a while. So same thing, if we could apply the same thing, same scenario to the labor market as well. Given the fact that the concentration of job growth is seen as a warning sign, it makes it even more important that the Fed doesn't drop the ball now that it is so close to the finish line. Now, I am in no way, shape, or form suggesting that the Fed should lower the rates to 1%, as President Trump has indicated. Absolutely not. whether the rate should stay at high levels, the current high levels, that I'm not sure. Whether you need a rate cut in July, I'm more in favor of a rate cut in July than waiting all the way in September, because you never know, the wheels might just come off the labor market and there might be pandemonium. Now, the main reason why Chair Powell remains hesitant is that the Fed thinks while tariff-driven inflation is yet to materialize, they still can't fully rule it out. We're about to find answers, crucial answers to how the tariff picture will be in the coming days. I already gave you a little bit of picture that he has imposed tariffs starting August 1st on these nations. However, there was one piece of good news last week, which is that President Trump announced a trade deal with Vietnam on Wednesday, and that actually drove the market to a high. And, last week, Trump had said he will not extend the current pause in reciprocal tariffs. That is not exactly true. He has paused it. It will start now kicking in on August 1st, but the announcement has been made yesterday, which is 7th of July. So, it's what has essentially happened is the approach from the Trump administration marks a complete shift from rapid deal making to more drawn out negotiation process using deadlines and threats as bargaining tools. The uncertainty has implications for global trade, U.S. industries, and diplomatic relations. We still don't know, right? Yesterday, he says Japan, South Korea all will have to pay reciprocal tariffs. Next week, I'm on the show, episode 134 comes out, and I'll probably be like, guys, I'm so sorry. Whatever happened last week, that was just an outlier. He's gone back to the drawing board. This is all part of a negotiation tactic. It's just that the rule book has changed. The rule book has certainly changed. It's gone from rapid deals, pro-America, America. Right now, it would be, let's draw it out. Let's draw it out as far as we can, because if we have the leverage, we're going to use that leverage to get the best deal out of us. That's exactly what happened. Now, a deal with India, however, remains very close. So Dr. Goes Home listeners should probably enjoy that one. But beyond that, there's nothing major that has happened. You had a deal with the UK a long time back, which was essentially, to me, it was just like whatever. It was pretty much like, it's the only nation where the US is a trade surplus, guys. So please don't count the UK deal as a deal. As a significant deal, the one that could change, one that could show you the pathway for how the Trump administration negotiates. That's not how it works. Vietnam, yeah, okay, fine, that happens, but Vietnam barely trades with the US anyway. It's the other way around. So I think the US consumers would still suffer. Now, likes of Japan and South Korea, I'm more interested in. India, I'm definitely interested in. Japan and South Korea have already got letters. Whether India will receive a letter tomorrow or not, or whether the deal will be finalized, remains to be seen. Now, those are the power pack nations with whom there is a lot to gain. There's a lot of trade happening both ways. So those are the nations that I would keep an eye out for. So there's a lot of uncertainty. I get why the Fed is like, okay, there's a lot of tariff-related uncertainty. Tariff-related uncertainty means there's inflation. Inflation means, I don't want to lose the fight in my last year, says Chair Powell. But really, I think he should start paying attention to the job market, essentially, because there's a labor market is starting to weaken, and that does spell trouble as far as I'm concerned, as far as my opinion goes. Now, I'm saving the biggest development of the week for the last, and it's that against all odds, President Trump has finally got his big, beautiful bill. In other words, the big, beautiful tax bill has now become law, ladies and gentlemen. I'm not sure how many of you like it or not, but I'm going to speak it from an economic. It's not a political show. It's a finance show. I'm going to talk it from that perspective. And it actually happened, whether coincidentally, I don't know, happened on the 4th of July. And the president, amidst all the hullabaloo related to the celebrations of fireworks across the board, signed the bill into law. What was surprising is that up until last week, there's absolutely every chance that it would get derailed, but that's politics for you. Nothing certain until the job's done. Okay, all the hullabaloo over, bill has become law. What does the bill mean for US investors? And when I say US investors, not just US consumers, US investors across the world. The big, beautiful bill is projected by economists to provide only a modest and short-lived economic boost. While some Americans will see immediate tax relief and increased government spending, the legislation's longer-term consequences include higher deficits and potential risks to future economic growth. The bill is expected to increase GDP by 0.2 to 0.5 percentage points in 2026, compared to a scenario where the 2017 tax cuts were simply extended. Temporary tax cuts and increased spending provide a front-loaded stimulus. However, economists project that tariff increases under President Trump's trade policy could reduce GDP by about 1% in early 2026, offsetting much of the bill's positive impact. Remember, the bill is expected to boost by 0.2 to 0.6. Tariff-driven uncertainties are related to go down by is expected to move GDP by 1% down. Net, economists predict negative. But just to let you know, it's not an insult against economists or whatever, but these are projections. Yeah, these are all projections. So not defending them, but I'm giving you these projections. You got to make the investment decisions based on these projections and based on your own research. Continuing with projections, longer term, economists do see a plethora of risks. If made permanent, apparently, according to them, the bill could add $5.5 trillion. I haven't done the math myself. $5.5 trillion to federal deficits by 2034, pushing debt to a 127% of GDP. Not particularly great news. I was never a fan of raising the debt ceiling anyway. I think it's just too much. Higher government borrowing may raise interest rates and crowd out private investments, ultimately reducing economic growth. I'm not saying this, projections are saying this, but I tend to agree with this part. If the debt ceiling's gone up and if there's higher interest rates, factually, this is correct. This is not opinion. This is a fact as clear as day. After the temporary tax cuts expire and spending cuts take effect, the bill shifts from fiscal expansion to contraction, according to them. Finally, by 2034, economists say that the economy could be 0.3% smaller than if the 2017 tax cuts were allowed to expire. 2034 is about 9 years away. A lot of things can change between now and 9 years. So not sure exactly how you could say 0.3% smaller, but hey, this is why projections and assumptions, this is why valuation and projections are an art, not science, right? So only time will tell. But I don't like the debt ceiling. I'm telling you right now, I don't like this increasing the debt ceiling one bit. I don't like the 127% of the GDP debt. Don't like it at all. That much is true. And so US investors, if you this is my opinion, is the fact that the debt ceiling bit, not a fan of. So do what you got to do with that information. But that's just how I feel. I just never think it should go beyond, a certain level. 127%, absolutely not. Now, that's the economy. That's the economy. That's the economic projections for the US economy. Who's winning? Who's losing? From a corporate perspective, from a company's perspective, and which sector should you focus on potentially? Biggest winners, oil and gas companies by far. Chip makers, semiconductor manufacturers breaking ground on new US plants get a 35% tax credit. That's up from 25%. Incentivizing domestic productions for companies like Intel and Micron. I've given you two names to do your research. Defense contractors also are winners. About $150 billion over 5 years is allocated for major defense projects, including a $25 billion down payment on Golden Dome anti-missile shield, benefiting firms like Goldman Sachs and Palantir, everybody's favorite stock, Palantir. So I'm not invested in it, but I've given you two more names. I've given you Intel, Micron, Lockheed Martin, Palantir Technologies. Airlines are yet another beneficiary. $12.5 billion is allocated to overall the nation's air traffic control system, which industry groups see as a step toward modernization. But you know what I think about airline stocks? They're trading instruments, not investments. Finally, manufacturers also stand to be one of the biggest beneficiaries. Companies can fully expense the cost of new factories if construction starts after Jan 19, 2025, one day before President Trump's inauguration, and is completed before 2031. They also benefit from faster, more permanent write-offs for equipment and R&D. So your biggest winners, oil and gas companies, chip makers, defense guys, defense contractors, airlines, and manufacturers. On the other hand, who are the biggest losers? Biggest losers would be, unfortunately, AI and tech companies. Although I have to put a caveat here, I could pound the table and say, put a caveat there. If you're going to determine your AI investments based on this bill, please don't, is what I would say. Okay, yes, AI and tech companies would be losers. You know why? I will tell you, and you can make the decision for yourself. It's because a proposed ban on state-level regulation of artificial intelligence was removed, exposing these tech firms to a patchwork of state rules. We know how these state rules go. We know how legislation takes place. There are multiple Mag 7 companies that are still playing out court cases right now, Meta, Google among them. Both of their stocks, I don't know, not Alphabet, definitely not Alphabet, but Meta is at an all-time high. So stock market moves, actual moves in stock markets with court cases and legislation, not necessarily a correlation. So please don't Just because I'm saying one of the biggest losers would be AI and tech companies doesn't necessarily mean they are bad investments. In fact, I'm going to discuss a tech company later on and tell you why it's a good investment, in my opinion. Do your own due diligence, absolutely. But do not, in my opinion, please do not use the big, beautiful tax bill as a reason to sell your AI investments. That's all I will say. Obviously, reason for Musk versus Trump 2.0. EV manufacturers are other losers, are yet another set of losers from the big, beautiful tax bill. Federal subsidies of up to $7,500 for EV purchases end after September 30th, challenging automakers already facing slow EV sales growth in the United States. And this is probably President Trump gives this reason as to why Musk is unhappy with him. Musk has other reasons. Take some popcorn, enjoy the drama. I'm not discussing anything further on that. Except for one thing, that apparently Musk has started a new political party. Look into that, but make sure your popcorn, ready while you read about it, because it's going to be a pretty entertaining read wherever you read it. Not discussing it further here. Shippers and online retailers are also considered to be losers because duty-free importation of packages worth $800 or less from most countries ends, potentially reducing parcel volumes for companies like FedEx, UPS, and DHL. And you know where I stand on FedEx. I'm not particularly a big fan of the company. Nothing to do with the big, beautiful tax bill, but just this gave me another reason to not like that company particularly. All in all, taking all things together, you know the winners, you know the losers, you know the projections, you know the jobs report, you know the Fed, you know what the Fed should do, in my opinion, all of that. All in all, investors might be excited by the short-term boost, but the long-term implications of the big, beautiful tax bill do look murky. For the time being, however, sentiment is likely to focus on what goes on with tariffs, and I was spot on with this because yesterday that's exactly what happened. Markets ended in the red because they were too concerned with tariffs rather than the big, beautiful tax bill and the benefits out of it. Any negative news from the tariff front going forward, just like yesterday, is likely to put off investors, especially since the labor market is showing signs of cracking. Investors might be angling for more rate cuts from the Fed, given the state of the labor market, but should further tariffs be imposed, it would be a massive blow to all the positive news that the administration has been offering with respect to trade deals. President Trump achieved the unthinkable with the big, beautiful bill. The tax cuts would be seen as a positive for investors. However, in the very near term, all investors would be hoping for is that his love for tariffs don't crush their hopes. On that note, set to the next segment, Doctor Goes Home. Got a massive fan behind me, still sweating. Really humid conditions. Anyway, so there goes my pen. Right. Welcome to the Doctor Goes Home segment. Now, a lot has been going on in the Indian markets these days, with the latest being the drama surrounding the hedge fund Jane Street and its alleged market manipulation through derivative trading. You also have the India-US trade deal at the 1-yard line, despite a myriad of uncertainties. We don't know how that's going to go to an end. All of this, I promise, I will touch upon in the coming weeks. I'll discuss it in detail in the coming weeks. But this week, I have to talk about Indian automakers, especially since, as always, on this show, a new month means it's time to take a pause on all the market action and focus on the Indian auto sales numbers. Trust me, the news is not particularly great. June was far worse than May for Indian automakers, with sales going from staying flat to actually declining. More specifically, total sales fell to around 320,000 units, down from 342,000 units in June 2024. Domestic sales were even worse, declining for the second consecutive month, dropping by approximately 6% year over year. This downturn is attributed mainly to weak buyer sentiment, with many consumers deferring their purchases. Let's get to the top car makers individually now, as we always do. India's largest car maker, Maruti Suzuki, reported a 6% year-on-year decline in total sales, with figures dropping to 167,993 units from 179,228 units in June 2024. This decline can be primarily attributed to weak demand or in the entry level and compact car segments, while even as exports reached a record monthly high. Across all its segments, sales declined, with mini and compact segments seeing the worst of the declines. However, what was concerning to me is that even utility vehicles, something that has been, helping Maruti cover up the declines in the mini and the compact segment. Even they, even that segment showed a signs of decline, and also saw their sales tumble. Management cited concerns surrounding affordability as one of the main reasons, with entry-level prices jumping over 70% since 2019 on account of stricter regulation. The only saving grace, as I mentioned before, was Maruti's exports, which actually hit yet another all-time monthly high, jumping 22% year over year. Hyundai sales continue to decline with a 6% drop year over year experienced in June. Exports, however, continued their upward trajectory, registering a year-over-year growth of 15%. Management attributed this to the steep decline in domestic sales, attributed the steep decline in domestic sales to weak buyer sentiment and ongoing geopolitical uncertainties. Management, however, also expressed cautious optimism for a gradual recovery in domestic demand, supported by reductions in repo rates and improved liquidity due to a cut by the RBI in the cash reserve ratio. They also mentioned the upcoming production at the Talegaon plant as a potential positive for future sales. Mahindra & Mahindra, which continues to be my favorite automaker, auto name, telling everyone how much, I've told you guys so many times how much I love this name, and it continued to be the only outlier, registering yet another double-digit year-over-year growth in overall sales. More specifically, the growth came in at 14% year over year, driven by very strong demand in both the utility vehicle and the tractor segment, marking the company's highest quarterly sales for SUVs. Domestic SUVs sales registered a strong growth of 18% year over year. What's even more positive for M&M investors is that the company's SUV and tractor segments are expected to maintain momentum, supported by new product launches, favorable monsoon conditions, and continued rural demand. The outlook for the upcoming Kharif season is optimistic, with expectations of strong tractor demand due to robust agricultural activity and supportive government revenue. Finally, among the four-wheelers, moving on to Tamo, sales continue their downward trajectory, dipping 12% year over year domestically and 15% year over year drop overall. Tata subsidiary, Tamo subsidiary Jaguar Land Rover also not doing particularly well. Little frustrating for a long-term investor like Tata, for a long-term investor like me, but I am again putting it's in the penalty box for sure. I still haven't sold any shares. I'm optimistic, cautious optimism I'm continuing to use, but but I'm not exactly convinced. I'm not my idea on Tamo is not as conviction. It's not filled with as much conviction as I am with Mahindra & Mahindra. Only saving grace for Tamo is that the EV segment continues to remain a growth area for the company, although in my opinion, looking ahead, that could also be affected by an increasing competitive landscape in the coming months, as well as the export curbs put forward on rare earth magnets by China. So that could also be a major issue. Management continues to remain optimistic about a rebound in commercial vehicle volumes in the coming quarters. The company cites favorable monsoon forecasts and government-led infra development as key factors expected to boost demand. That's the four-wheelers. Now we move to two-wheelers. Hero MotoCorp continued its growth momentum, delivering a 10% year-over-year growth in total sales in June. Growth was driven by strong domestic demand and a whopping 140% year-over-year surge in exports. The company attributed its strong performance to effective product mix realignment and rising rural demand. The Vida electric scooter segment also continues to gain traction with over 7,000 units dispatched in June. TVS Motor, yet another company that I absolutely love, continued its stellar growth, registering a 20% year-over-year growth overall. Exports continued to surge for the company, registering a whopping 54% year-over-year increase for May. Royal Enfield continued its upward trajectory, primarily driven by exports, which surged 79% year-over-year for May. Bajaj Auto was also back into positive growth trajectory, primarily driven by a surge in exports, as domestic sales only saw a modest uptick. Those were the numbers. Bottom line, but when you look at the sector overall from an investor's perspective, then in addition to slowing domestic sales on account of weak buyer sentiment, there are other key issues that investors, if you are an auto investor like me, need to factor in. One is the problem surrounding the rare earth magnets from China, on which the country has put significant export controls on, and which is currently threatening the Indian automakers, and it is preventing Indian automakers from taking advantage of what has been a very robust monsoon season. The persistent shortage of heavy rare earth magnets is now in its fourth month and is a direct result of the export restrictions imposed by China. The supply disruption predominantly threatens to stall the rapid growth of India's electric two-wheeler market, and companies are already reacting to this. Bajaj Auto, for instance, is expected to halve its electric two-wheeler output. TVS Motor, despite launching its brand new iQube, is also preparing to pare back output. The shortage has already led to production target cuts for other makers such as Maruti Suzuki, which slashed its maiden EV production target by 2/3 for the April to September period in 2025. Industry executives warn that if the standoff continues, the entire Indian EV segment could face widespread disruption, potentially derailing the country's ambitious EV adoption goals. The National Critical Mineral Mission, NCMM, was launched to secure domestic and international sources of critical minerals, but immediate relief is very much unlikely. This is an issue, ladies and gentlemen, that you guys should not take lightly, and it's one that investors really need to look out for. Any management or government commentary on this matter should be followed with utmost seriousness, especially if you have invested in EV manufacturers. Second, there's the ongoing chaos and frustration from automakers surrounding the corporate average fuel efficiency or CAFE norms, which aim to cut car emissions by 1/3 from 2027, more than twice of that of the previous target. India's auto industry is strongly opposing these norms, warning that this could lead to billions of rupees in penalties and threaten future investments in the $137 billion sector. What's more intriguing is that the proposal applies different emission standards for small lightweight cars versus the heavier models. The government is also considering ending sales of petrol and diesel vehicles by 2040, a move that faces strong industry resistance, and rightfully so, because all of this sounds good on paper, but in reality, executing this is going to be anything but straightforward. Take Europe, for instance. Even with better charging infrastructure than India and higher EV penetration compared to India, it is still struggling to meet its own 2035 fuel car ban targets. Setting these concrete norms, to me, makes absolutely no sense, because it's not like I'm going to flick a switch and gone. It's going to be world is suddenly gone electric. No, you can't just flick a switch and everything goes green. So once again, I don't understand these concrete norms, especially the 2040 target. Doesn't make any sense to me. And I really hope the government and the policymakers kind of pare back these stringent reforms. And as far as Indian auto investors are concerned, they should definitely keep an eye out for, as it could very well determine the growth story of the Indian auto sector going forward. On that note, ladies and gentlemen, we're heading to the final segment, Dr. Dissects, where yet another Mag 7 name I'm bringing you for this week. And that is Facebook parent Meta Platforms, ticker Meta, META. Now, Meta had its Q1 earnings released sometime in May, and it was a very strong quarterly performance. Okay, management guidance was also very strong. No signs of slowdown in AI spending, as many on Wall Street had feared. On the contrary, actually citing growing demand, management increased the 2025 capex guidance and now projects capital expenditures for the full year to be in the range between $64 and $72 billion. This is a significant increase from the previous guidance of a range between 60 and 65. Finally, the tax rates for 2025 for the company are now estimated to be between 12% and 15%. Not unnecessary, not very important. I want you guys to focus on the capex announcement that they've increased the capex guide from the previous range by nearly, like, it's 64 to 72. Previous guidance was 60 to 65. Now, Meta's announcement that it would boost its capex investments for the year did come as a surprise to me, especially given the challenging macro environment that the company operates in. However, when you look at the company's ads business and the user engagement, then it becomes very clear that its AI investments are already paying off, especially in its biggest market, the US. Take its advertising business, for instance. Unlike its peers, the company's ads business has been resilient so far, and it has its AI investments to thank for that resilience. The company's average revenue per person in Q1 jumped nearly 10%. And while the year-over-year growth has slowed overall, when one looks at the US and Canada market, then it shows that growth has picked up once again after an initial period of decline. Now, when one looks at the management commentary, then it becomes very clear that AI played a major role in ensuring that the company's ad revenues have remained resilient even when times were tough. For instance, in Q1, the company saw a 30% jump in the number of advertisers using AI creative tools. Moreover, the company tested a new ads recommendation model for Reels, which saw conversion rates grow by 5%. Finally, AI is also driving up the rate of engagement, as seen by the 7%, 6%, and 35% jump in engagement on Facebook, Instagram, and Threads, respectively. What is interesting to me is that by leveraging AI, the company has managed to turbocharge the user engagement in Threads, as evidenced by the fact that it now has 350 million monthly active users, or MAUs. In addition to ads, the company's hardware business has also received a boost via AI. Ray-Ban Meta AI glasses, for instance, have seen its sales triple. More recently, the company tightened its privacy policy change in order to improve the Ray-Ban Meta experience. And while this may raise privacy issues, it should allow the company to train its AI models used on the glasses faster, which should obviously improve the overall experience, including enhancing the model's ability to process different accents, dialects, and patterns of speech. Users can also delete each recording from the Ray-Ban Meta Companion app if they don't want the device to use their data. So it's not like entirely privacy is dead, but that's a different debate. Now, Meta's reality labs have been losing money on a consistent basis for a while now. While in the short term, I do expect the division to continue to lose money, in the long run, I do anticipate the Ray-Ban Meta AI glasses to be the catalyst that would unlock profitability and growth for this particular division, especially since research suggests the overall wearable segment is expected to grow at over 60% CAGR through 2029, CAGR CHER. Finally, there's also the recently launched standalone Meta AI app expected to compete with the likes of ChatGPT and other agents. While the agentic AI space is getting crowded, the natural question is whether there was any need for Meta to launch a standalone app, especially since Meta AI is available across all its family of apps. That question was asked during the Q1 earnings call, and CEO Mark Zuckerberg suggested that the standalone app could be important in the US, given that WhatsApp is playing second fiddle to iMessage in the region. As such, a standalone app, especially in the US, would allow the company to differentiate itself, and given it has an added social media component, which other AI bots currently don't have. Taking all these use cases together, it's very clear that AI has played a major role in not only ensuring that the company's core business remains intact even during challenging times, unlike its peers, but also it has allowed Meta to build its next growth catalyst. Moreover, given that the company is already generating an ROI on its investments, and given that the demand for its AI tools is expected to surge, both from an internal and external perspective, the increase in CapEx spending rate makes complete sense, in my opinion. With regulatory overhangs and a challenging macro environment looming over its head, it is absolutely vital, in my opinion, that the company continues to leverage its AI capabilities to maintain its growth story, even if it means spending more money than before. Also, don't forget, Mark Zuckerberg currently is on a hiring spree, and he's already got the entire team of Scale AI thanks to a multi-billion-dollar investment. He's also offering pay package worth up to $100 million. Wish I'd taken a computer science degree and stayed on the AI front. By the way, $100 million pay packages to prize people away from competitors. It has also created a new AI lab to pursue super intelligence as he aims to get ahead of competition. So that's all about the AI. Now, so all in all I've got to say is Meta with AI, I think it's far ahead. And I think, it's one of the direct beneficiaries of the AI. And story continues. I mean, whatever people say, that story is going to be, that story is not going to change anytime soon. I have a paper and I have a pen. That can only mean one thing, guys. Ladies and gentlemen, we're about to do Meta's valuation. Now, according to LSEG data, the consensus FY25 EPS FY25 EPS for Meta is $25.39. Okay, Meta's EPS is $25.39. It's different notebook, same, but the policy is the same. On average, the company has beaten analyst estimates in 3 of the last 5 years, with FY21 and FY22 being the exceptions. Average magnitude of the beat in those 3 years was 5.33%. Assuming the company beats the FY25 estimate by this margin, not unreasonable in my opinion, given the strong start it has had to the year, then the FY projected EPS would be 26.74, and it would represent a year-over-year growth of 12.1%, marginally higher than its long-term average growth of 11.65%. So FY25 EPS would be 26.74 in my projections. Yeah, 26.74. Now, according to LSEG data, Meta currently trades at 26.4 forward PE. Forward PE of Meta is 26.4 times, making it the second cheapest name amongst the sensational 6, with only Alphabet having a lower multiple. However, it is currently trading above its historical multiple of 22.5x, but the median PE of the sensational 6 currently stands at 29.7. Now, I used 4 different combinations, the forward PE multiples and the EPS growth rate. So essentially, it became 26.4, 29.7, 26.4, 29.7. And what I did was I essentially put 12.1, 11.65% as the growth rate, 12.1%, 11.65% growth rate. FY25 EPS is 26.74, 26.74, 26.7. So let me just quickly show you. So this is what I did. So I had 4 tables here, 26.4x, 29.7, 26.4x, 29.7x. Growth rate different, 12.1, 11.65, 12.1, 11.65. Okay, so essentially that's that different growth rates, and then you use the projected EPS of 26.74. You get different growth rates and different price targets, right? So different combinations, 4 different price combinations, which means I get 4 different price targets. The average price target for Meta becomes 838. Okay, it's an all-time street target, high street target. Don't care. That's my projections that come in. So 838, which actually represents an upside of about 16% from current levels. The company also has an excellent momentum as reflected by B+ grade on the Seeking Alpha momentum scale, and a very, very strong short-term momentum of A- as reflected on the Seeking Alpha momentum scale. So ladies and gentlemen, with a price target of 838, I'm initiating coverage on Meta with a strong buy rating. So initiating coverage on Meta with a price target 838 and a strong buy rating. Every time I say buy or strong buy, it can only mean one thing. You got to talk about the risk factors. So the biggest risk factor to my bull case, my strong bull case, is the regulatory troubles currently plaguing the company. Management during the Q1 earnings call already hinted that there would be a potential headwind on revenues from Europe as a result of the DMA, Digital Markets Act. While the company has said that it would appeal, management mentioned that the headwinds would appear nonetheless. Then there is the massive antitrust trial, which is currently ongoing, through which the FTC is seeking to break up Meta. It would be a massive blow to the company should it lose, although the final outcome could be a long time away, but a risk nonetheless. The other risk factor to my bull case is the macro headwinds to its ads business. Management during its earnings calls already cited that Asia-based e-commerce exporters have already reduced their spending ahead of the de minimis exemption. And the de minimis exemption has already gone through in the big, beautiful bill. The average revenue per ad has also seen a steep decline in Europe, and should conditions worsen in the US, it would have a negative impact on the company's top and bottom lines. Bottom line. Meta had a very solid start to the year with a beat on both the top and bottom line estimates. Operating margins also came in strong, and it generated strong free cash flows. At the same time, the company announced that it would be significantly boosting its CapEx spend to keep up with the AI demand. To me, the increased spending makes complete sense since the company is already reaping the rewards from its AI investments. The ads business has been resilient. Ray-Ban Meta AI glasses are flying off the shelves, and a standalone Meta AI app is well positioned to grow even in a crowded space. Threads is on track to be the next core app thanks to a surge in engagement, once again, thanks to the company's AI models. From a valuation perspective, Meta remains attractive at current levels, in my opinion. Investors have always questioned whether the investments made by the likes of Microsoft and Amazon would pay off within a reasonable timeline. When it comes to Meta, though, in my opinion, investors should have no such questions. That's all the time I have for you this week. My God, it sounded like a long episode, but I thoroughly enjoyed talking to you guys about all the developments that took place, even though last week was a pretty shortened trading week. Anyway, that's all I have the time for you this week. If you have a specific Indian or US stock suggestion for the doctor to diagnose and dissect, do tweet me, as always, Edothamvinay, UTHMBINAY, or email me on the Stock Doctor Podcast at gmail.com. Thank you once again for listening. Enjoy the weather if you're in the UK, but do stay hydrated, given how hot it's going to be in the coming days. More importantly, see you next week. Until then, stay safe and make some money.